All right. Hello, everybody, and welcome to this week's edition of the SelfWealth Live. This is our mastering your mindset, markets, and methods, or something along those lines, isn't it, Gary? There's a few M's in there, but I welcome Gary Stone to the show once again. How are you, Gary?
Yeah, pretty good. Thanks, Roger. Looking forward to this one. There's some big picture stuff in today.
Yeah, definitely big picture stuff. In fact, I've never heard when you explained this to me, I never heard the whole 95-year market cycle concept. So I'm really looking forward to learning a lot about this. I welcome everyone else on the other side of the line today. This is the second episode of our 4-part series with Gary. Now, Gary's part of SelfWealth Systems. And he can tell you a little bit more about that near the end of the show, obviously. But my name's Roger, and I'm from SelfWealth by Syfe. So looking forward to hosting another great show here to do with this episode, which is the 95-year period, and learning about market cycles. So without further ado, I have to get through to obviously the disclaimer, the formalities. So let's just have a quick look at that. Welcome everybody once again on the other side of the line. Don't forget, if you have any questions, just pop them in on the chat. There's a bit of a chat down below or to your side, depending on what device you're looking at. We'll have a bit of time potentially at the end where we can answer any of your general questions that you may have. Okay, so let's just have a look at the disclaimer here. Now, if I open this up here. As you can see here, well, the disclaimer, sorry, I can't see the first page of this. Oh, there we go. Now I can see the first page once it pops up. Here we go. All right. So here is a disclaimer. Now, obviously, this is SelfWealth. This is hosted by SelfWealth. Nothing we say here or do, takes into your personal situation. So please, obviously, seek your own personal financial advice around this. Gary is part of SelfWealth Systems, so that we are obviously separate businesses. SelfWealth doesn't endorse anything that obviously Gary does, but obviously you'll be able to see what he does throughout this show. And if you click any links down below, you can obviously go and see everything to do with SelfWealth Systems and their disclaimers on their website. And it's just showed on a display in front of you right now. Okay, so that's the formalities, Gary. Like I said, we are going to go through a few questions. I'm going to ask the questions. Let's just close this off. And we're going to get back to our faces. All right, Gary. So let's get on with the show. It's going to be a very interesting topic, and the way for me, I've been in this game for about 10 years in investing in shares, and I think this show, even for me, I've come at the perfect time where I feel like I'm starting to hit a little bit of success over the last couple of years. It's taken me a while to get there, right? So I hope a lot of viewers can probably relate to this. But this is a topic that, as I was saying before, I've kind of never thought of it, never heard of. So I'm really looking forward to hearing more about it. So first of all, Gary, explain to me, what is a secular market cycle?
Okay, good. Before I put the slides up, just very big picture, if you like. This is all about perspective, and secular has a number of different meanings, but it also has a meaning when it comes to the stock market. And effectively, it means like ultra long term is really what it is. And I first heard the term from Martin Pring, who wrote a book called Technical Analysis Explained, and I think it's in about its 6th or 7th version. And he's world renowned for intermarket analysis and big picture stuff. And there's even bigger cycles than the ones we're going to talk about today, but we won't get into those. So it's long term. When I put up the first slide, it's going to intrigue people, and they're going to go, well, what does all that mean? And I'll go through that. So let me share my screen, and then we will be able to do this. Right. So effectively, what we're going to be looking at is long-term cycles. And the first slide to look at is this, which is a 95-year slide of the S&P 500 going back to 1930, and it's current to a couple of days ago. And what I'm going to do is put into perspective what the sideways movement markets are and the ones and the rising periods, okay, and put names to them and give you a bunch of percentages so you can actually understand what, and this is what everybody should really have a picture in their mind all the time while they are investing. And what this does, this perspective does, is it takes you away from one of the biggest problems that people fail to solve in their active investing careers, and that is one of short-termism, where people get taken out of their long-term plans based on short-term movements in the market. And having this big picture perspective plays a huge role in being able to get away, to solve this problem and overcome short-termism and volatility in the market and knee-jerk reactions and impulsiveness and all those things, which all lead to trading errors, which we spoke about last week. So the first secular bear market was basically after the 1929 crash, sideways moving, 20 years long, breakout, and the secular bear market lasts until the breakout out of it, right? And you'll see failed tops. So there are failed tops over there, and there also are deep drawdowns, so 60% over 5 years that fall. And then the same thing, then we had this rise, and then we have another secular bear market, lasted 13.8 years, and 36% fall there over 1.5 years, 49% fall there over 1.7 years, failed to make new highs, to break out into new all-time highs, so fail at those tops, if you like. And then the third one, the most recent one, lasted from 2000 to 2013. And the first drawdown fall, if you like, 49.2 over 2.5 years. The second one, 56.8 over 1.4 years. And then we had the breakout, right? So trade secular bear market, failed to make a new high at those tops, and have deep what we call primary bear markets. So within a secular bull bear cycles, you get primary bull and bear markets, and then you also get secondary bull and bear markets. So this is all big long-term analysis. So immediately now you see that we've got these run-ups. So what are those run-ups? Well, those run-ups are secular bull markets, and they're measured not from the low down there, but they're measured from the point of breakout, which was 1949 in the case of this first one. A 465% rise over 18.3 years to that top there, and then sideways. The next one was a huge 1,200% over 17.6 years from the breakout to that high over there, and then went into long sideways moving market. So a secular bear market doesn't mean down, the opposite of the secular bull market. It means long sideways, deep drawdowns, failing to make new highs. And then the one that we are currently in has been going 12.6 years. So immediately now, viewers, people who watch this are going to start getting a bit of a feel for some time frames and percentages and that sort of thing. And so 12.6 years. So how long is a secular bear market, bull market cycle? Well, Martin Pring and others, John Murphy and others, have written about them lasting 17 to 18 years, a 17 to 18 year cycle. But you can see that we've got from 13.5 to all the way out to 20 years, somewhere in that range. Because then it's important to start getting your head around these numbers, because the secular analysis is saying that we could have anything from 1/2 a year to 7.5 years remaining in this secular bull market that we're in now. So immediately, I'm sure people are thinking, well, how do I set myself up for that? Because really what you've got to try and avoid is the secular bull market, the secular bear market. So just going back, as to where we are now, we've been going 12.6 years. We've had a 323% rise from the breakout in April 2013. And so if we take that 12.6 years in the last secular bull market cycle, how much had it risen? It had risen 340%. So pretty similar there. Do cycles and markets repeat? Certainly they do, and you'll see some more similarities in a moment. And the first secular bull market of the century that we got here, after 12.6 years, had risen 240%. So we're a little bit ahead of that one. Now, if we now look at where people started timing, and these are the big mistakes. If you've got this picture in your head, you'll understand the mistakes that people made who measured the bull market from March of 2009, which is the final trough of the last secular bear market. And you might remember, it certainly fit into your investing career, or maybe not. But they started measuring. It's 3 years. It's 3 years of bull market. It's 4 years of bull market. It's 5 years of bull market. It's 6. Every March, April, we had this. Coming up to sell in May and go away. They were counting. There's been 6 years of bull market, but that had only got us to like 2013, 14, 15, 16. And they were measuring it from the wrong place. They had to measure it from the breakout, not the last big trough, right? So you had all of these market commentators calling the end of the bull market. And of course, what secular bull markets do is they climb this wall of worry. And there's always going to be negativity and noise and all sorts of stuff around that are calling the end of it. But what secular bull markets do is they persist. They keep persisting in their rise. And it's not a straight up rise of 45 degrees. So that period from there, let's putting some more perspective on time, is 16.7 years from March 2009, and we've risen 878% from there. Now, when people see that who've only been in the market, relatively short time, they think, wow, because their anchor is there, and they don't have the rest of this picture in their head, which in my view, every investor, not only active investors, should have, because it just sets up this perspective, and you get, you can understand where you are in this long-term procession of this thing called the stock market. But along the way, you have bears, right? So there was a 25% fall over 282 days in 2022, which they've called the inflation bear. There was the COVID crash, which is a geopolitical event, affect markets, obviously, 33.9%. So you get primary bear markets within secular bull markets. And in the same way as you get primary bull markets within the secular bull markets. And that's when everything lines up, when you get the secular, the primary, and the secondary all lined up. That's when it's time to be in the market. So how long did this, rather than taking it from the breakout there in August of 82, or you can say October of 82, if you take it from the last trough, how long did that last? A quarter of a century. So we effectively had 25.5 years of bull market from that last trough. And so where's that? Well, we were about 9 years shy of that. But we had that 1987 crash in the middle of a secular bull market, and looks pretty similar to the COVID crash, doesn't it? 33% and a half percent in 55 days, smack in the middle of a secular bull market. So that rise was 2,353% from there to there over a quarter of a century. How did the other one do? The one from that was about 1938, I think it was, or 36. It was much later than that. But the rise from that last trough all the way up to the peak there, that was over 26 years, another quarter of a century, 1,300%. So now we're starting to get some perspective on how long it can last from the trough, and that gives us another time frame. Also, a Kennedy slide, 1962, a big bear market within the primary bull. So using the secular analysis to going from last trough to final peak, we could have 8.8 to 10 years remaining, to get this 16.7 years up to a quarter of a century of secular bull market, right? So using those two different analyses is now giving you some perspective and can help you get away from short-termism. So if the S&P 500 replicates either of the previous two secular bull markets, we could have, we 12.6 years into a 13 to 18 year cycle. Well, we could have by 2026 through to 2035 is the whole range of when the secular bull market can end. We could have the S&P 500 rise to 8,835, which would be replicating the first secular bull market after the 29 crash and the 49 breakout through to 65. Or you could get all the way to 20,500, and that's just 1,000% rise, not a 1,300 or 1,200% rise as happened from 1982 to 2000. So these are big numbers. And when I first put these up, back in 2014 and 15, when I recognized the first secular bull market breakout, I got a few emails from customers saying, you got to be joking. Go back to, is it 1,500 back then? And we are talking about, these sorts of numbers. and we are sitting at 6,600 now at the moment. So the secular analysis is pretty powerful. So what happens then? Well, then a secular bear market will start, and that's what we got to talk a bit about, coming from here. So that really answers the question: is what is a secular bull market? What's a secular bear market? And getting that picture into your head. So hopefully that has been helpful to do that.
Certainly has, Gary. And if I look back at going back to that chart, if that's any chance there, I do like to see the perspective of just seeing, let's say, the 87 crash or the COVID downturn, and things that have happened just recently in our lives. Obviously, COVID, our 20% pullback at the start of this year. They're just such small pullbacks, yet in general, so much fear is talked around these events. But when you look at this overall, this chart overall, they're such tiny blips in a much wider picture, right? So
absolutely, and it's just what people have asked me over the years, and I've come to the conclusion, that the number one thing that causes the biggest mistakes and errors that active investors and even buy and holders, when it really gets tough, they're no longer buy and holders. They start selling and they start going into cash and all sorts of things. That number one thing, which I call short-termism, is the short-term knee-jerk reaction to volatility in the market. People have to, and that is not a technical thing. I can, all these pictures and all the technical analysis we'll look at, and others coming in the coming, next week and the week after, it's a psychological thing, and people just don't get that. They don't want to get it. It is the number one thing. Is this emotional reaction that people have, to look at the market. What did they say the other day? $68 billion wiped off the market. What they didn't count how many billions, many more billions are in the market that have grown over the longer term leading up to that 68 billion. But the noise that comes from the market, from the news and everywhere else, and the stuff you read, it undoes people, and how does that manifest in their trading? They make mistakes. They make big mistakes, and those mistakes are the manifestation of poor investing, active investing and trading psychology. So you need both. You need the analysis, the big picture, but you need to be able to have the wherewithal, the resilience to be able to handle these things.
Yeah,
and big picture analysis helps with that.
Yeah, of course, it certainly does. And I think for me, just particularly, I've not been in the markets as long as you, Gary, and some others that I speak to, right? And anyone else that might be watching this from being in the markets less than 10 years, less than myself, seeing this once again can give you, look, at the end of the day, we all know past performance doesn't equal the future, right? So yes, it can. From what you've said, we've potentially got another 7 to 10 years of bull market according to this secular period, right? But it could potentially go the complete other way, and it could be the beginning of a bear one. We just don't know that, right? Ultimately, but what it does do for me is gives me a little bit more confidence that with what I'm doing with my active investing, or even if I was buying and holding, to hold my nerves, keep calm, just sell off when everyone's telling me to sell off in the real world, let's say, and just keep calm, because there's still potential more to come, right? So, but as you know, it could all go backwards, and we've got to make sure we say that to ensure that.
Just stay calm. Easier said than done, Roger.
Yeah, for sure, 100%. So, but hopefully this perspective can provide a little bit more confidence to investors. So, all right. So that said, Gary, how would investors identify these turnarounds?
Okay, well, just to pull you up on the one thing you said, 7 to 10 years. I mean, that's the positive side of it. It could take it could be next year, so it could be by 2026. So looking at the analysis, it could be half a year. The minimum could be half a year. The maximum could be 10 years. Yeah. Okay. So and then the secular bear market starts. So when you see this, so what do you do about this? It's nice knowing this information. Is that what action do I take now? What should I go and do about this? Well, first thing is you got to start preparing for a secular bear market, because it's going to come, and when it does come, you're going to have long-term sideways movement. So how can you analyze it now? So the problem we had, if you look at those charts, is that you don't know you're in a secular bear market until many months, maybe even a couple of years, and from a technical perspective or anything else, right? And nor will you know from a news perspective, because the news and the noise and everything that comes out from the commentary brigade is the same for every little blip you have during a secular bull market. And you won't be able to differentiate between the noise that the commentary brigade make, when the secular bear market does start, and all the other little blips they've had along the way. It'll be the same stuff, right? So you need to build the skills, analytical skills, to be able to follow this. So along the way, you can have potential falls in a secular bull market of anywhere between 10 and 35%. And that's how do we know that? Well, from history and the 87 crash and all those that have happened. But the predicament that an investor has is how to be optimistic about a secular bull market that's maturing, if you like, and as it continues to mature, while also risking a 35% fall within the secular bull market that we're in, right? And also this fear of and knowing that another secular bear market is going to start. And this cycle happens because of all of the variables that kind of collide and conspire through business cycles, through the human, if you like, building of greed, and all the mistakes that chief executives and C-suite people are going to make, as like they did in leading up to 2008, where they over leverage, they do all sorts of stuff, they get cocky and complacent and all that sort of thing. Chief executives do it, C-suite do it, football teams do it, everybody does it, all the way down to the individual level, right? And that is why having a neutral mindset in no matter what walk of life you're in is so important. But it's almost, you just have to have it when you're an active investor. So trying to deal with the fact that it's definitely coming, just don't know when. How do you set yourself up for that? And that's really what we have to talk about. So analyzing the secular cycle, is it's easy to determine the start of a secular bull market. I went public back in February of 2013. I wrote an article for the Australian Technical Analyst Association, and I said there's a potentially a secular bull market that's imminent. If this happens, that will happen, right? And I was talking about a breakout above the previous two all-time highs in the S&P 500, and it happened in April. And I wrote another article and say it's happening, and that got published in the ATAA, and people that are members of the ATAA can go and look it up in the archives and find it. And you might even be able to search on it on the internet and find it. And then after it happened, I said, this is what's going to happen. It's going to retrace and test the all-time high. If it bounces off that all-time high and makes another new all-time high, in the next few weeks to a couple of months, we are into a secular bull market. And I watched all over the commentary and everybody, and nobody picked it. But it's easy to pick once you have the skills. Now, I'm not going to be around probably when the next secular bull market starts. After this one ends, we get through a secular bear market. Probably won't have my marbles. So I've got to make hay while the sun shines in this secular bull market, but also protect my wealth in the next secular bear market and deal with that secular bear market, with an active investing type strategy. So it's easy to determine the bull. It's very, very difficult to determine the end of the secular bull market and the start of the secular bear market. So I've done tons. I've spent hours, probably months and months of my life looking for that. And to be objective about, to find objective signs that potentially alert the end is very difficult. But I've come up with a few. And this is, some of this is not my own work. I found it just through other people doing it. And it's not, this is not obvious stuff that's around. But one of them, and I'm not going to go through all of them now, I do an update every 6 months for our clients and people that are on our list. But one is the 14-month RSI. And how do we know that? Well, the three secular bear markets we've had, this is a 14-month RSI. There's limit lines here. And effectively, when we were in a secular bear market, we find that the 14-month RSI falling below this lower limit line, which I think is 30 or thereabout. And that persisted. Now, so what we're looking for on the right-hand side, this is up to date to just a couple of days ago. Sorry, it's a monthly chart, so it'll be the end of last month. And when we see these signs, look at that sign, there's early, that happened pretty early there. This happened into the secular bear market, that line going down there. But it at least showed us a big difference. So this is not one sign. You don't just go this sign and this sign alone. But this is one of the things we're watching. I'll give you a list in a moment, the other things we're watching. But we are looking for this monthly to drop down below that red line as a first sign that we're in a secular bear market. So I do this every 6 months with our clients, and that just to keep an eye. Another one of the early signs, and I'll only go through 2 charts, and then I'll just list some of the others without going through all the analysis. We don't have time for that. But is the gold to equities ratio, and here we have the secular bull market from October 82 through to the top in January to March of 2000. And what happens when you have an equities bull market, a raging bull market like that? In equities, gold goes sideways. And look what happened here when the secular bear market started, and we kind of could confirm it from, let's say, the RSI that I just showed you, the monthly RSI I just showed you. Gold started rising, right? And then we hit secular breakout. The breakout happened in April 2013 over here, back into secular bull market in equities. Look what happened to gold. Now, the only sign I can find at the moment is this bull market we have in gold at the moment, this breakout because there were no new all-time highs in gold going across here. Breakout there, and now we're sitting around about 4,000, as we all know, is that we've got equities and gold going in the same direction, and both are in quite raging bull markets, if you like, secular bull markets. So is this an early sign? Or are there other things at play here? Well, we don't know yet, but there are other times where we've had these gold lines over here where equities and gold have risen in unison and quite strongly. Even in a secular bear market, we had them rising in unison. So I don't know yet, but it's the only early sign I've had that we could potentially have this happening over here, and therefore we've got a secular bear market in equities imminent. But I'm not going to make a prediction one way or the other. We're just going to let the charts continue playing. It's not the only analysis you should use. There are other analyses we should use, which are got to be vigilant of thresholds. So thresholds are of support and resistance, big long-term monthly type thresholds, like I showed you in the first couple of charts, and looking at because one of the things, one of the traits of a secular bear market is it doesn't make new highs, right? It gets stuck at an all-time high, and then it falls, and then you have many attempts for it to get through or just fall strongly from there. If we continue to make new all-time highs in the S&P 500 and other indices around the world, then that is a strong trait of a secular bull market. Secular bears don't do that. So if we continue to make new all-time highs, let's also keep watching those and watch support levels, medium to longer term support levels, not daily support levels and resistance levels, and also understand that it's okay to have 20 to 35% declines in a secular bull market. So if we have a 25 or another 30%, it doesn't mean that the secular bull market's over. But if we get to a 40% or a 45%, then the odds are that we're going to go to 50 and maybe more. In the last secular bear market, the NASDAQ 100 fell 82%. Okay, so don't just think 50% because that's where the S&P 500 got, or 56%. You can get to 80-85%, and stocks like CBA fell over 60%. In the last secular bear market. So big, large cap, behemoths are going to fall 60 or 70% in those bear markets. So them falling, less, way less, 20-30% is fine. It's acceptable. Keep an eye on the monthly RSI. There's also the COPOC, which is a monthly indicator you can look at, COPPOCK. And another thing that I've also found looking back is that when we have a negative first year in the presidential cycle, that seems to be a signal as well. But that's a pretty long-term signal because that only happens every 4 years. And the biggest one, which is more a feel thing, not so much an analysis thing, is keep an eye out for euphoria. And one of the things that's amazed me is market commentators in the last two couple of months, even less, have been talking about there's euphoria in the markets. Well, they probably weren't around when the euphoria at the end of the 2000s. I'll show you a chart in a moment, but I can assure you now there's no euphoria around. Euphoria is when everybody is talking about stocks, particularly all of those who have never invested in their life before are getting into stocks. That's euphoric. It's the cabbie driver. It's the it's people at the clubs or the people or wherever you frequent. family dinners, people that personal direct family, never spoken about, they talking about it, and they're talking about, they know somebody who's in it and all that. That's euphoria. We are nowhere near it at the moment. So I'll give you a quote as to why euphoria is so important. This comes from Sir John Templeton, famous fund manager, hedge fund manager. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria, right? And that is one that I've had in my head for many years now. One of the difficult things to try and work out is I think the euphoria is far easier to pick. I can remember it back in 95 to 2000 or 98 to 2000. It's difficult to pick whether we are in skepticism or optimism, while the bull market, the secular bull market goes. And I think we flip-flop between the two, right? And we're probably more in optimism. We were up until a couple of week or so ago, but we're definitely not in euphoria. So what can euphoria look like? What other data can you look at? So this is the ETF flow, and I'll go to the ICI, the Investment Company Institute. I've been following them for about since I started researching my book back in about 2012. This is the flow by year going back to 2000 of ETFs, right? And of course it is pretty new, particularly in Australia, but ETF started in 93, index ETF started in 93 in the US, but they are just growing and growing and growing. So this is one I'm going to keep an eye on, which really wasn't a good data point back in before 2000 because it just hadn't caught on. But that goes up to 24. We can't quite see it behind our pictures here. 25 still has to be filled in, but they come out with an annual book. But this is just growing rapidly. And it's one of the data signs, if you like, of a bit of euphoria. Everybody's climbing into the simple trade, buy and hold index ETFs, and which will work brilliantly in a secular bull market, but ain't going to work so well in a secular bear market. And this is the cumulative US ETF flow, net issuance. So that's net, that's going in and out, but it's just climbing, right? And in my view, over the next period, just before we get into the secular bear market, this is probably going to be growing vertically. Everybody's going to be in on the same trade, index ETFs. And then we're going to hit a secular bear market, and buy and hold ETFs are going to be a really poor strategy. So what might the euphoric end look like? Okay, we have got this profit loss line over here, which is this that goes to there. This is the S&P 500. And in the last 5.3 years, from January or basically through to March of 90, I think that goes to, that top is about March of 2000. The S&P 500 grew at 25.9% annualized growth, right? 230% over 5 years. And if you think that's great, the NASDAQ grew at 44% annualized. That's the magenta line. And biotech, the biotech sector grew at 56% annualized all the way up to there in the last 5 years of the secular bull market. And that's what I think we're going to get. The NASDAQ and the S&P 500 will be in it. It might not be the exact numbers, but it's going to be pretty similar. And if you start taking 232% or 500% on the NASDAQ from where they are now and work out what that number is, you just won't believe it. But that's what happened last time. And will it be biotech this time? I don't know, but I'll be certainly watching the biotech sectors. But the one I'm watching closely is the SOX, the SOX, which is a sector of the NASDAQ technology sector. And there are other technology sub sectors out there, which are what I'm keeping an eye on, because when they start really going like this, and that, remember, that was like the last 18 months, 2 years. That's euphoria, and we are definitely not in that at the moment. Yeah. So, does that answer that question?
Yeah, for sure. I'm just thinking, thinking of euphoria. I've got some family and friends asking me about getting in the stock market for the first time, especially around AI. I certainly think there's a lot of euphoria going on around AI. Yeah. But yeah, I mean, you've just said, look, keep an eye out on technology. So I'm assuming that's the sector that covers AI and the NASDAQ, right? So yeah. All right. Very good, Gary. I think there's some great data to go on, and I especially like that, seeing once again the confidence in seeing the fact that the RSI had not hit below those levels on the lower level side. So if you don't know what an oscillator is compared to the chart above, obviously you probably need to do your own research around that. But you could quite clearly see that the oscillator was still pointing on the way up towards the upper line versus where we were in that bear market. Even at the start of the bear market, the oscillator had hit below the lower line there, right?
And it's not going to just go down from where it is in 1 month or 2 months. Yeah, that'll take 3, 4, 5, 6 months for it to work its way down there. And I don't think we're going to have at this stage, with the lack of euphoria around, are we going to have a cliff? We're not going to fall off a cliff. It'll build slowly, and then when we're in it is when the cliff stuff happens. Like October 2000 is October 2002 was when we fell off the cliff, but the secular bear market had started 2 years earlier. Right?
Very good. All right, so
not 2 years earlier. It started back in 2000. Sorry, the October 2000. It was the end of 2002, and then we had the same in 2007 as well. Yeah. Sorry, 2008. Yeah.
I don't expect you to get all these years data points right, Gary. You're bringing up a lot of great points, but I think we get the picture here. Okay. So, all right. Well, so these cycles obviously occur according to their own rhythm. We obviously never going to know ultimately, as I said. We're quite bullish still, obviously, in what we're sort of talking about, but it could be going the complete other way. How does an investor's investing lifespan overlap with these secular market cycles?
Okay, and this is now we're getting to, okay, what do we do about having this knowledge, right? So what we've done here, and we've kind of just summarized it, if you like, but this is through researching many other people's work and things like that. And what we've done is we summarized it into, an investor has 3 stages in their lifespan of investing. And the first stage is effectively from, when you start working, if you like, and getting an income through to 55, right? And that is, where, and you're in that phase now, and we call that stage 1. And stage 1 is, the best strategy, if you like, for that, which wasn't available for me when my stage 1 started, is buying and holding an index ETF and reinvesting the dividends. It really, really is a great strategy. If you have, but that means you have to sit through, and why is it, first of all, so good for stage 1 is because you have time to recover from a secular bear market. Okay, and it's given the time span of a secular bear market, you can live through it and come out the other side and not have had to rely on your long-term investing capital, which is superannuation or IRAs in the US and 401ks and that sort of thing. You can live through that, and the market will recover, and your investments will recover. So that's stage 1. If you have an inclination to trade and be more active prior to that, that's brilliant. I started at 29, and I have absolutely no regrets that I did, but I was certainly not. None of my friends were doing it at the time. But if you do, that's great. But when you get to stage 2, it starts at 55 and through to 65 as our general ages, but everybody retires at a different stage. But it's kind of your near retirement, pre-retirement years, where a whole bunch of things that were the focus and filled up your time prior to that, kids and family and career and all that sort of thing. You now start thinking to the future. Where are my investments? How am I going to live when I don't have an income coming anymore? And that's pre-retirement. Now we call that stage 2. And then stage 3 starts when you retire. So the worst thing that can happen for somebody in stage 2, but definitely stage 3, is if your stage 3 starts and coincides with the start of a secular bear market, because now you're going to have long-term sideways and buy and hold index ETFs and managed funds and balanced funds and all that sort of thing. And the research, I wrote a book on it. Looking at target date funds are the worst thing. People think target date funds and even balanced funds are protected from this sort of thing. They're not, particularly with a lot of the industry super funds here in Australia now going into unlisted assets and private equity and things like that. I mean, the hedge funds got smashed in this time. The target date funds, which are supposed to hedge against these things, got smashed. Some of them were down 40, 50%, even more. And they're supposed to protect against these things. So you shouldn't assume if you're in a balanced fund or a managed fund that you're going to be protected from a secular bear market. It just depends which ones you're in. And then it comes down to the particular strategy of that particular fund and how they're set up for it, which means you have to go in and analyze it in detail. You can't just go into any old balanced fund and it's going to be okay. She'll be right. She'll be apples. It just doesn't work like that, right? So you're still going to, that means you still have to do analysis. You still have to go and work that out for a managed fund, right? And if you buy and hold an index ETF, all you're going to get are dividends, if you like, over the full 13 years. But the dividends aren't going to protect you from the 50, 60%, 80% falls in the case of the NASDAQ. So that is the worst strategy to have. And my fear is for the investing fraternity out there, everybody that is kind of keeping an eye on it, is that the buy and hold index ETFs are going to be at a crescendo just when the secular bear market starts. And there's going to be havoc, right? Because we don't know how the whole financial market scene is going to react, how the index ETF is going to react when there's going to be so much money in these index ETFs when the secular bear market starts. There's definitely going to be selling upon selling that happens because everybody's in the ETF, and what comprises the ETF? Stocks, right? So when the stocks start falling, the ETFs start falling, we're going to have to see what happens and how they handle that. But you've only really got two defenses against a secular bear market, and that is do not sell, right? You are genuinely a buy and holder, and you've got to be prepared to sit through 13 to 20 years and genuinely, 100% genuinely be passive, right? And you can do that by diversifying across across different asset classes and ETFs. So you can start bringing in bond ETFs and gold and fixed asset ETFs and things like that. So there's platinum ETFs, there's silver, there's gold, and you can get into bonds, and you can kind of construct an RV portfolio through ETFs. So think about that, but definitely do not sell, right? And the other defense is to actively invest. So what does that mean? It means you sell. You have an exit signal. You predefine before the secular bear market starts the conditions under which you are going to exit, or you're going to start exiting and potentially go 100% in cash. Because during secular bear markets, when you have the primary bear and a secular bear, the number one asset class to be in is cash. Okay, it's cash. And we'll see how crypto plays out. We don't know how crypto is going to react to a secular bear market. It's going to be the first time ever. So we'll see. And we see now how crypto is falling kind of in unison with the market. So it's kind of joined in, with equities at the moment. But sometimes it breaks away, disassociates from equities and kind of latches onto gold a bit. But it doesn't do that all the time. And why is that happening? Because the market's still trying to work it out, and so are active investors trying to. So active investing, for me, which is obviously the path I've chosen, and I'm biased towards it, is that it just liberates you. It liberates you, and it overcomes the fear and having this like sword of Damocles hanging over your head that this thing's going to start at some stage, and I'm not prepared, right? So active investing is the way that I've gone about it, and it eliminates the need to predict, because the sword of Damocles disappears when you have a set of criteria in place, like the RSI, 40-month RSI is one example of that, where you are vigilantly keeping an eye on these things. And you don't have, it's not going to happen overnight. It's going to develop over weeks and months that you'll be able to recognize this. So that's what I would recommend that people do. But of course, everybody should do their own research and work out where their inclinations are and how they want to go about this and how they want to prepare. So does that answer that question?
Yeah. I mean, look, if you go back to that last slide, because I particularly like this one, I just want to make a final comment on those two defenses. Like, even if you're once again beginning, having this understanding and knowing it's either one of those two. If you can't put the time and effort into active investing, then you've got to be ready to sit through the down period in those ETFs and the companies, the blue chips and all that you hold, right? So it's so important just to understand that they're basically your two defenses. And I'm in your camp a little bit as well around active investing, because I find it a little, obviously it's the ability to trade actively in individual stocks as well and to grow faster. Certainly in my stage 2 of life, it's probably a bit easier than you wouldn't do it. I mean, I know a lot of investors that do in stage 3 as well, active investing, right? But understanding those stages is also really important. And some of these things, I think, why weren't we taught this stuff in school, right? So if you ever wanted to get into investing and share trading, so I love what we're learning here, Gary. All right, so on to we've talked a little bit though. They're the sort of top line sort of strategies and how you're going to deal with the bear cycle. Is there any specific investment strategies that work best, and which are the most sort of? Is there any dangerous ones? Which are the most dangerous?
Yeah, absolutely. So nobody can predict the future, right? And so if you don't know what's going to happen, and if you really genuinely believe that you can't predict and you don't need to know what's going to happen in the future, then you can put in place a regime, if you like, that you overcome this fear and prediction and all that sort of stuff, and also you don't succumb to the noise, because the noise over the last, I reckon, from about 2012, from about 2012 to like, what's that, 13 years, the noise has been wrong every single time in calling the end of this market. And I'm talking about, I can find newspaper clippings and stuff I've kept, of big names, even guys like Druckensmiller and these guys that have made billion-dollar trades and things like that, have called this wrong time and time again. Not to mention Narelle Rabini, who's just called it wrong every time. These guys, Harry Dent and others, there's so many, 80% fall. He's been calling it 80% fall for the last 7 or 8 years, right? It eventually will happen, but you've got to, you can't listen to the noise. You have to set up your own routines, and you have to continue to change. If you don't have a plan and a set of criteria and a strategy in place, you're going to continue to be pulled from pillar to post, right? And you're going to continue to change your decision criteria based on the noise that you hear. So you have to prepare a plan for come what may, and you have to trust it. So what do you do? And I'll just give you a quote. Dennis Waitley, a hero of mine from my sporting days back in the 1980s, is expect the best, plan for the worst, and prepare to be surprised, right? And you won't get surprised if you've prepared for the worst and planned for the worst. So, but what you can't do is stop now because you fear something that might happen, like the Rabinis and the Dents and the Druckensmillers and all these guys have been predicting for so long now. Because if you listen to them, you would have been out and lost all the growth. Now, the thing is that when this growth ends, it's going to be gone. It's going to, unless you become a lot more active than what you are, and a lot more vigilant than what you are in the secular bear market. So people who are in it now have to make hay while the sun shines, but have this sword of Damocles hanging over their heads. Just remove that and do the plan. So so the best strategies for a secular bear market are not, I'll tell you what they're not, is buy and hold index ETFs and managed funds, buy and hold stocks, or balance funds and target date funds. And we got people target date funds, an American term, but a lot of the super funds have moved towards the target date fund model, where you pick a date and then they invest according to when that date comes. They are really poor investment strategies, really, in all secular bull and bear markets. And you also can't, you can't rely on your discretion and your intuition and look at different analysis and modify as you go. You just can't do that, because in a secular, you can do that in a secular bull market, because you can be wrong often and still you're not wrong so badly, and you can, like the monkeys picking stocks, in a secular bull market will do it. But when it comes to a secular bear market, those who haven't done their preparation and done their analysis and their plans are going to get found out big time. And it's going to be when everybody's in the market, right? So why? Is because you're not going to have growth for 13 to 20 years. You're only going to have dividends. So I don't want to steal the thunder of the last show we do, where we'll get into more detail, with active strategies. But whatever the active strategy is and whatever analysis you use, you have to start getting on that. And the more mechanical you are, the better. And you're going to, because why? In a secular bear market, you're going to have 40 to 80%. 45 to 80% declines, and that's what you need to be avoiding. I'll carry on. Sorry, I thought there might be things. So you have to avoid most of each primary. So how do you prepare? You got to avoid most of each primary bear market. So within the secular bear market, when it happens, you're going to have these big down legs and big up legs. You want to avoid the primary bear markets within a secular bear market, and you want to minimize exposure through. So you want to if you look at the exposure of a portfolio from April 2013 to now, you're running at something like 80 to 85 to 90% invested, and the other time you're not as cash. In a secular bear market over that same period, like 12, 13 years, your overexposure drops dramatically because you'll spend half of the time in cash. So it drops down to 40, 50% levels. And how do you do that? You do that through objective and consistent timing. So you want to spend most of the time, a lot more time in cash during a secular bear market, but you want to make the most of the primary bull markets. And I'll show you what I mean, because you want to maximize exposure on the up, minimize it on the down. And listen to what Warren Buffett said. I think this quote is like from the 1960s. He made this quote. In a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages. So that's what he does. And then then what he does is he keeps his powder dry during the bear markets by going into cash. So this is the last secular bear market, which is the worst you can expect in investing. That was leading into it. So that's a primary bull market, primary bear market. You want to be out for most of this time, and you want your strategies to avoid these dead cat bounces that happen. So you get dead cat bounces, everybody talks about it, is a trait of a secular bear market. It's not a trait of a secular bull market. And that is why so many people got caught out in COVID. COVID was still in this, it didn't signal the end of the secular bear market, of the secular bull market, and it was in secular bull market conditions. And it proved to us that's why it made a new high. And you want to be in during this time here, primary. So this is bear, secular bear, primary bull, primary bear, primary bull. So you want to be in where the green is. And you can only do that with some medium to longer term timing strategies to do that. You don't want to be buy and hold ETFs, because the only growth you'll get from there to there will be dividends. And you've got to have the mental wherewithal, which is purely a psychological thing, to be able to sit through the entire thing, which very few people have.
Yeah. I mean, once again, even just going back to that chart there, Gary, I think most people can relate to that last COVID dead cat bounce there, where it just bounced back down to where it happened in 2002, right?
Yeah.
If you had never had that perspective, you would have been freaking out at that point there, and not knowing that they just reached a previous support level at that point, right? So having this perspective, in the longer term is super important for any investor, I think. All right, we're going to get into more around, we talked about ETFs and we talked about being cash in bear cycles and whatnot. We're going to talk a little bit more about that over the final two shows. But look, given that anything can happen right now, how should investors mentally prepare themselves? Knowing that we could potentially, we're still thinking that the bear market second might come in a few years, but how can they prepare themselves just in case?
Yeah. So the thing that I tell people is that you need to start an active timing approach, before the bear market starts. If you start trying to learn all this stuff and get a plan, an active investing plan together, even if it's long term. And the one strategy I hold, does like 30 trades a year, or even less, 25 to 35 trades a year. And that's like a long-term trading. And I've got others and that's a position trading system. And then I've got a swing trading systems, which are 6 to 7 to 8 week hold periods, which are, you do more trades over a year. But you can't think when it comes, I'll get there and do it. You've got to do it beforehand. You've got to do the preparation beforehand. And before you can get your mind around it and be psychologically prepared to do this, you have to get your analysis and your plan and your criteria in place for what's going to be your call to action, to act at the time, because you won't just feel it and do it correctly in the time. You have to do the preparation, right? And it takes 6 to 12 months once you've got a plan in place, to acquire the habits and the systems and the processes, to be able to successfully navigate your way through a secular bear market. Then I've lived through one. At the time it started, I didn't know the transition at the time, even though I'd been, at that time been doing this for 9-10 years. And I just met Martin Pring in 1997, and I was still getting my head around all this sort of stuff. And when the transition happened, I already had a mechanical system in place, and it did its job, but I didn't really understand this big picture at the time. But then I traded right through with an active strategy, which is a more swing trading strategy, right through that period, and it did brilliantly well. Why did it do well? And as I was going through it, I was working this out, and now this picture is plainly clear to me as to why it worked then. But it was a medium-term equities trading strategy, and it kept me out of most of the downs and kept me in most of the ups, and it worked, right? And of course, ETFs were very new in Australia. Hardly anybody was using them in that 2000 to 2010, 13 period. But now I'm prepared. I'm absolutely prepared. I see the picture in my head. I've got the systems in place. I've got the mental wherewithal to do it, and I feel liberated because I can say to the market, throw your worst, do your worst, and I'm prepared, right? And sure, it's still going to be difficult, but the degrees of difficulty will be way less having been prepared, particularly mentally, and getting the psychology of active investing done. Because if you haven't practiced that in a secular bull market and got a high degree of feel for it, you've got no ways of being successful at it in a secular bear market. You just don't, right? And so now's the time. Now's the time to be in a secular bull market when things are pretty good compared to a secular bear market. Now's the time to be gaining those skills, practicing your process and your routines, and handling the small little dips, with your strategy, before the big falls come. So that's how people should be preparing at the moment.
Yeah, I totally agree. And if I'm actually going back to your previous comments around the big money makers in the industry, the ones that have made billions, calling these bear markets at the wrong time. Yeah. Even now, if I think the latest one is obviously Michael Burry of The Big Short. He's calling another big short, and I'm sure a lot of people that aren't in the know are sort of thinking similar things. And I think to myself, had I have not known anything that I've learned over the last few years, I'd be sitting in that same position and not being prepared. So now that we're in this bull market, yes, it can take 6 to 12 months as you've got it up there, right? Why not? Even if you don't go down that active investing method, and you just want to buy and hold in there, why not learn now? Because you're still going to be exiting out of positions in a bull market, right? So learn how to actively manage that. I think why wouldn't you, if you're in the share trading game, and people just think, oh yeah, I'm just going to invest in shares and it's all going to work. And I just I say, all right, good luck. But yeah, I certainly think education of 6 to 12 months in this game is so important, right? So you bring up a very good point, Gary.
Yeah.
Is there any final comments you want to make around this before we sort of wrap up here? Or
no, just that I can remember hearing this from a gentleman by the name of Colin Nicholson, who basically started the Australian Technical Analysts Association in Australia back in I think he started in the late 80s or the early 90s, probably I think the early 90s. But I've been a member of it since 1995, and I was sitting there, I thought, I've been doing this gig for 8 or 9 years. I know it all, right? And I remember him giving a presentation just talking about the euphoria. It was like late 1999 and what was happening in the markets. And he was saying, this can't last. Now, he was coming towards the end of his investing career. And I think he retired and got out of it, probably about 9 or 10 years after that. But some people might recognize his name, Colin Nicholson. And I walked out of that presentation thinking, I can't see that happening, because I was caught up in the euphoria and the portfolios I had were going gangbusters, and you can't contemplate the end of it unless you've lived through it before, right? And he had lived through the 70s, right? And he had seen the secular bull market start and all that. He didn't call it a secular bull or bear market. I got that from Martin Pring. But and you can Google secular bull market cycles, and you'll find a whole bunch out of there. Those of you that are listening, and I'm sure you'll get slightly different views on it to where I've come to, if you like. But so why am I saying that? Because take heed of this. It really is. It's probably, I do a 6 monthly update with our customers, and it's probably the most important bit of perspective that I give to them and we've been following this now for since about 2014. I've been doing these sort of 6 to 8, 9 monthly updates of where this is at. And I've pulled apart all the different market indicators, interrelated market analysis and all that sort of thing, and kind of distilled it down into just what I've done today. And if you just got that picture alone without all the other stuff that we've looked at, it'll definitely help you. But don't just walk away and think this is not going to happen. It's going to happen.
Yeah. Yep, I totally agree. All right, I think we will wrap up there. Have a look what's on screen right now. Now, obviously, this is something that is so true to my heart, and that is education. Hence why we're doing these sessions, right? So you can check out Gary's giving you the opportunity to train with SelfWealth systems down below for free for a few months, basically. So even if you don't go the 6 to 12 month mark, at least you can try for the first few months. And even if you don't try any of the active investing strategies, then at least you've got that a little bit of education in your pocket ready down the line when it all happens, right? So don't want to prepare people for the worst, but it is important. I think it's been incredible amount of value that you provided today, Gary. So I really appreciate it. Thanks for that.
It's a pleasure. And one of the things we'll include, if you follow the links that'll be in the description, is that we've written a white paper which basically goes through the 3 stages of an investing lifespan, and that'll be available for people who follow the link and go through with there'll be a video that you can access and watch as well. So, and in that video is where you go through and we'll explain the offer that you just basically said, where effectively you can go through our training with us mechanical systems and with the psychology trading that we do, highly based on Mark Douglas. And we also bring James Clear Atomic Habits into it as well, where you can basically what I've said there and on that slide is what you'll walk away with is being fully prepared for the next secular bear market. Yeah.
Exactly. All right, so you can check those links out down below. Obviously, if you're not a SelfWealth client, you can check the link down below as well and get yourself 10 free trades to get started. We want you to come back either way to our last 2 sessions next week and the week after on a Thursday. They'll be at 2 p.m. We're just changing it up from the morning to the afternoon. That's Australian daylight savings times, obviously. You can hit the like and subscribe and give us a comment below. Let us know if you're loving these shows or got any questions. We'll follow up on them. You can always put them in the comments. But yeah, please like and subscribe, and that will help us out as well. All right, Gary, thank you very much once again for your time. Thanks to all the viewers for coming along and being with us, and hopefully you've learned some great stuff. And we will once again see you next week. Take care, everyone. Bye-bye.